Back home now, and borrowers are being warned the official cash rate may reach 2.5% before the end of next year after the Reserve Bank lifted interest rates for the first time in almost 12 years. Joining us live now is the Executive Chairman of Yellow Brick Road Home Loans, Mark Bouris. Mark, good morning to you. So the honeymoon period is well and truly over now. So how much does this and many more expected rate rises change the game for borrowers and lenders such as yourself?
Okay, well, let me just give you a quick example. For every 0.5% increase in the interest rate, so we just recently increased by 0.25%. So for every time that happens twice, for every 0.5% increase in the interest rates, lenders will lend a borrower around 5% less. So if last week I would lend you $500,000, this week, and if this week there was a 0.5% increase in the interest rate, I'm only going to lend you $480,000. That means if your deposit is a fixed amount, you go to the auction or whatever it is however you're going to buy it, you've got $20,000 less to spend in buying that property unless somehow you can increase your deposit. So for every 1%, it's a $40,000 decrease. So borrowers basically will be able to borrow less because when we make the assessment, the calculation of how much we lend you, we assess on the current rates.
Okay, well, we had it good for so long. This was always coming. And with that said, with those interesting numbers that you just said, how will this affect the property market?
Well, there is some pundits out there saying for every 100 basis points, every 1% increase in the official cash rate by the Reserve Bank, property prices could be affected by 20%. Now, I have to tell you, I don't think that is possible to happen because that's ripping too much of the equity out of the Australian mortgage sector.
Okay, but I mean, in your metropolitan areas, Sydney, Melbourne, Brisbane, where does that go? Your main ones?
Yep. Well, if the average price of a home in Sydney, for example, is $1 million, for argument's sake, that basically means that we could be reducing the average price around $800,000 for every new purchase.
Geez, that's a big drop.
But that's for a 1% increase. And don't forget, the Reserve Bank is acutely aware of the wealth effect of people's property prices or the value of properties. So, we start taking the wealth effect out of our pocket, we stop spending money, and all of a sudden inflation gets under control. That's the whole hypothesis around increasing interest rates.
Okay, a few critics out this morning for Governor Lowe, particularly because he said only 6 months ago that these low interest rates are going to stay there until 2024. So borrowers took that on board and went for it, took on a big loan. Now they're going to suffer the consequences. So with that said, did Philip Lowe stuff up?
No, I don't believe that. I don't believe that. Philip Lowe and the Reserve Bank Board and all the bureaucrats that sit behind it to make the recommendations to that board base it on the data that they have in front of them. So 1 year ago, or 6 months ago, inflation was not 5%. Inflation was less than 2%. So based on the data that the Australian Bureau of Statistics had given them, which is always 3 months behind, then they make the decision. So you can't sort of blame someone if they operate on data. Philip Lowe's job or mandate is not to forecast out for the future. I mean, these inflation numbers are a result of 1,000 factors. And by the way, every Reserve Bank or Federal Reserve around the world, therefore, has got it wrong. If that's correct, and I don't believe that to be the case. And Philip Lowe and his mob are unbelievably good at managing the economy. Just, by the way, I can say to you now, Peter, that in 1 year's time, they'll have it exactly where it should be, inflation and the interest rates. It'll be higher than now because it's been too accommodative, but it will be exactly where it should be, and it'll be comfortable and it will work well and will be sustainable as well.
All right, there's the forecast. Mark Bouris, thanks as always for your time and your insight. We'll talk to you soon. Let's get